In this exclusive Opolis TV interview, pioneering quantitative investor Thomas Wehlen reveals the unconventional philosophy behind one of the hedge fund industry's most remarkable yet under-recognized success stories. With a 27-year track record that places his tactical asset allocation strategy in the top 0.5% of 170,000 Bloomberg-tracked funds, Thomas shares powerful insights on why chasing alpha may be the wrong approach and what investors should focus on instead, how intelligent diversification combined with strategic leverage creates a sustainable edge in global markets, the 5 core tenets of his investment philosophy that have delivered roughly 2,200% cumulative returns since 1998, why his flat fee model of 2% management and no performance fee better supports investor interests. We're gonna hear also strategic insights on navigating 43 global markets across equities, bonds, commodities, and currencies without trying to predict the future. Thomas' journey from computer science at the Swiss Federal Institute of Technology to developing his groundbreaking global leveraged indexing or GLI strategy at Goldman Sachs and UBS challenges everything conventional wisdom teaches about active management. Having grown $1,000 into over 23,000 over 27 years to August 2025, while maintaining lower correlation to equity markets than most funds, he brings a distinctly humble and mathematically rigorous approach to global macro investing. So don't miss this rare opportunity to learn from a fund manager who has not only survived but thrived through multiple market cycles when less than 2% of hedge funds even make it past 25 years.
So Thomas, pleased to meet you. Please introduce yourself, right, and your company. But let's really start with you. How did you get started with investing?
Yeah, hi, Matthias. Originally, I actually studied computer science at the Swiss Federal Institute of Technology in Zurich, and worked for a number of years in computer science. One of the companies I worked for was Dow Chemical. And there I actually met some people from working in their treasury department that was financing most of Europe. And I found this far more fascinating than coding and database management and this sort of thing. And at that point, I decided this is what I wanted to be in, and eventually went and did an MBA in California. And after that, worked for a few financial services companies, among them UBS, Union Bank of Switzerland in Switzerland, and Goldman Sachs. And during these stints, I slowly developed my investment philosophy, which we later implemented when we started this company.
Right. When did you start your company, Coburn, Barrett?
We actually started at the end of 1997. In San Francisco, because this was sort of the time of the dot-com boom, and we assumed it would be easy. This was perhaps an error on our part. It would be easy to raise money because, as everybody said, there was a lot of money around. And my wife was from San Francisco, so we felt this was a reasonable place to go and start this company. All our investments are basically based on the exact same philosophy. It's somewhere in between the global macro, tactical asset allocation, and risk parity, lies somewhere in that realm. We use a combination of heavy diversification and slight leverage to invest across all liquid, publicly traded markets. So stock indices, government bonds, money markets, commodities. And so it's actually sort of a two-step process. I think we should get this out right at the beginning. A two-step process. We create a portfolio that consists basically of stock indices, government bonds, and commodities. And so we end up with a portfolio that is globally diversified in stocks, globally diversified across government bonds, and diversified across commodities. And it usually ends up at about 45% equities, 35% fixed income, and about 20% commodities. And so we have a fairly low risk portfolio, which we then leverage up slightly in our flagship fund and to any risk level that an investor is comfortable with. After working at these banks where they're struggling to find alpha in many ways, I felt that maybe we should approach the investment process slightly differently in that we said, look, maybe the financial research, the academic research is not completely incorrect in that alpha is transitory and very, very rare. And that perhaps in the long term, it's not ideal to chase after alpha because you may find alpha in one sector of the market now, but then you struggle for many years to find it somewhere else once it disappears. So my question was really, how would one invest if if you did not chase alpha, right? How would you gain an advantage over other investment strategies if you do not chase alpha? Okay, so the philosophy is based on about 5 or 6 basic tenets. And the most important of those, I think, is that portfolio theory is particularly effective if you apply it across all asset classes. So if you apply it geographically across all countries and across all liquid asset classes, so those include government bonds and commodities and currencies and so on and so forth. And then the second tenet is that asset allocation is actually a major driver of long-term returns and not in picking individual stocks. Then our basic idea is that arbitrage opportunities are far too rare to really be the focus of long-term investing. These tenets are mostly based on the academic research in universities and in funds. And we decided to approach investing from a slightly different angle, saying, look, let's not chase alpha. Let's assume that financial research is roughly correct, that alpha and beating a market is very, very difficult. And how would you invest if you didn't know what the future would bring? So if you tried not to market time, if you tried not to predict the future. And then one of the last sort of tenets that go into our investment philosophy is that high fees don't necessarily mean high returns. So if you pay a lot of money to your investment manager, that doesn't necessarily mean you'll get a better product. It's not like a car. If you pay more money, you get a better and faster car. So this is sort of borne out in index funds, which charge incredibly low fees, but still do really very well compared to most active funds.
And your own fee structure is, of course, different, correct?
We have a flat fee structure, and I can get into why we prefer flat and why an investor should prefer flat fees over performance fees. If you charge a performance fee, that's effectively the investor giving the fund manager a free option, and the fund manager has control over the volatility. And an option price goes up as the volatility goes up. So what you're doing effectively is giving the fund manager the control over the value of his option. And what is he going to do? He's going to increase the risk because the value of the option is much, much higher than when the risk is higher. And he could theoretically have two funds running counter to each other, and one of them will make money if one's long, one's short. It's not an ideal incentive scheme for investors, and I understand why people like it because they feel the investment manager will work harder. But it's in a capitalist economy, it's a terrible incentive. Okay, so basically our feeling is also that the more turnover you have, the lower your return. So it's long only, and the weights change. The weights in the various asset classes or within the various asset classes change related to a model that we developed relating to the correlations and the implied volatility of the position. So we don't generally change weights or anything based on any prediction that we would make about what's going to happen in the near future, because we feel that's counterproductive and doesn't, even if we did know what was going to happen, we often don't know what's going to happen with the market. And there are too many extraneous variables to really predict what's going to happen with the market in the short term. But we have some inkling of what other people are expecting of the market, first of all, by these short-term historical correlations, implied correlations, and implied volatilities of these various markets. And that gives us some leeway to change weightings in the basic portfolio, and also to lower or increase the leverage. But we also include some aspects of behavioral finance. So when markets have gone down, expected volatility or implied volatility is usually very, very high. And so we would like to be even-handed about losses and profits, as opposed to the natural tendency of investors where they fear losses more than they're happy about gains. So that usually means that in times of high market volatility, or when markets have gone down, our implied value at risk or our implied risk is slightly higher, because the expected return at that point is also generally higher.
So let's look at your 27-year of track, right? I mean, somebody told me this is the best performing hedge fund that most people actually haven't heard about. So it's a 27-year track. It's among the 0.5% of 170,000 Bloomberg-tracked funds, right? And given that achievement on the performance side, what's also interesting is that only 2% or less than 2% of hedge funds have actually survived 25 years, right? So you're now in year 27. So tell us more about your track and the longevity, and now also the outlook, right? Do you see this opportunity that you're exploiting continuing?
I think the basic idea will continue to function. We're also, happy to add additional markets. Look, we always have more opportunities for diversifying. So, sometime in the last decade, we added carbon credits, which is an enormous market, which has turned into an enormous market in the commodity sector, and we look to add the Chinese local markets, for example, because at the moment, for technical reasons, it's not ideal to invest directly in China because there are capital restrictions, and we like, from our investor point of view, to always have a liquid portfolio that we can easily go in and out of and adjust, and for investors to get their money back, and so on and so forth. There are certain markets that we are still restricted from really using as much as we would like. We're always looking for new opportunities to diversify further. And we feel really, when we get to predicting, we make basically only one underlying prediction, that the global economy will continue to grow roughly between 3 and 4% a year in the foreseeable future, because that's what it has done for the last 20, 25 years. There will be, of course, further disasters in between. So we will have, I don't know, pandemics, wars, bad public policy, and so on and so forth. And we're positioned pretty well to ride out these bad times, and pick up the returns that come from global economic growth. And if we try to pick which country or which asset class will outperform in the next year, we most likely, sometimes we will pick a winner, but on average, we will most likely miss the most important market of the year. So if we're exposed to all the markets at all times, maybe to varying degrees. But if we expose to them all the time, we're long all of them all the time, we will ensure that we will gain from that global economic growth, because we don't know, maybe it's India next, or I don't know, Chinese government bonds, or who knows.
So in executing an investment strategy, there is this continuum between fundamental, discretionary, right, to totally systematic and automated, right? Where are you with your strategy?
I would call us 90% systematic and 10% fundamental. So there are situations in 2008, for example, where we as fund managers felt we needed to make our own decision, because in 2008, I don't know if you 2008, 2009, and if you recall that correlations went to near one in all asset classes, including money markets, right? And that to us seemed purely a function of fear, because it makes no sense that um, that bonds and equities sell off as well as money markets, because money markets are effectively tied to the Fed funds rate. And if the Fed sees everything collapsing, their only order of the day is to supply the market with money, and so those rates had to eventually come down. So we far overweighted money markets in that market disaster. But in general, it's a systematic thing that we monitor but don't often interfere with.
You're one of the few funds that I interviewed with a 27-year track. Is there anything else that we missed in this conversation?
I think my feeling about most investors, this is something slightly related to our strategy, is that they underestimate their actual time horizon. So they switch from one fund to the other in a relatively short period of time. So what they effectively do is they invest in a few different investments, and then they throw out the losers. And if you throw those losers out too quickly, you lose a lot of return, because the losers may effectively just be that underperforming asset class of the year, but then you throw them out, and you effectively, what you're doing is buying high and selling low fairly often. And so we try to convince our investors that their horizon is actually much longer than they believe, and that they need to effectively stick with a given investment strategy over many years to find out whether it actually works. These are not necessarily stable numbers. So depending on how you measure them, first of all, depending on the time period you use, and depending on how much historical data you use, they vary over time from time to time. And so in our model, what we do is we overweight more recent correlations versus longer term correlations. We obviously keep in mind that the long term correlation of equities and bonds is minus 0.3, for example. But if the correlations go up, we obviously have to adjust both the weightings and the leverage, right? Because the implied risk in our portfolio goes up as the implied correlations go up. And if the correlation, for example, commodities to equities or commodities to bonds changes, the weightings in those classes will change too. And even within the commodity market or within the equity markets, Japanese equities, for example, recently their correlation to US markets has gone down quite a lot. So the diversification effect of being in Japan is higher than it used to be. The long-term correlation, of our fund and of our base portfolio is about 0.55 with the S&P and 0.6 with the MSCI, and that's measured on a monthly basis, and that shows the result of diversifying into other asset classes. So adding commodities and adding bonds makes a difference in terms of the correlation. The returns come primarily, obviously, from equities. So we expect over time 75 to 80% of the returns to come from equities, and 20% or so from the other half from fixed income, the other remaining percentages to come from fixed income. And the commodities are in there almost purely for diversification. So they're there to allow us to have slightly higher leverage in the equity portion, right? Effectively. Yeah, there's an overlay of currencies too, which is also not necessarily there to gain return, but it's there to reduce the day-to-day volatility and to allow us to run a little bit higher level of leverage than we otherwise would.
Right. Yeah. I mean, it's really interesting because you offer this high level of diversification, but from the performance side, you're actually beating the equity indices, right? So, Thomas, well done. I wish you all the best, right? I look forward to maybe visiting you in San Francisco one of these days.
Indeed. Yes. Thank you, Matthias. You're very welcome.